Silver just had its worst single-day crash since 1980, a 30% collapse, panic everywhere, mainstream media telling you the bull run is over, but here is what they are not telling you. Goldman Sachs just raised their gold price target. JP Morgan says $6,300 by year end, and Bank of America is calling for $6,000 gold. The biggest banks on earth are not selling, they are buying. And today I am going to break down exactly why they are loading up, what their exact price targets are for silver and gold, and the 3 signals that tell you this crash was manufactured to shake you out before the next leg up. This is not financial advice. This is market news and analysis. Before we get into the data, smash the like button right now, drop a comment telling me how many ounces of silver and gold you are holding, and subscribe for daily silver and gold updates. Trust me, you are going to want to see what Goldman Sachs is projecting, because the number shocked even me. So let us start with what actually happened. Silver was trading at $72 an ounce at the start of 2026. By January 29th, it had exploded to a record high of $121 per ounce. That is a 60% gain in less than a month. Gold had already blasted past $5,000 an ounce for the first time in history. Everything was moving exactly as the fundamentals predicted. And then on one single Friday, silver collapsed. It dropped from $115 all the way down to $85 in a single session. 26% gone in hours. By the following Thursday, it was sitting at $73.50. Nearly every single gain from 2026 had been wiped out. Gold took a hit too, dropping almost 10%. The headlines screamed that the precious metals bull run was finished. Panic selling, forced liquidations, margin calls cascading through the system. But here is the part that nobody in the mainstream is explaining. And this is critical, so pay close attention. This crash was not caused by a change in fundamentals. Not one single fundamental driver of the silver and gold bull market has changed. Let me say that again because it matters. Not one single fundamental has changed. What happened was purely mechanical. The CME raised margin requirements on silver futures. When you raise margins, leveraged traders who are borrowing money to hold positions suddenly need to post more cash. If they cannot post more cash, their positions get liquidated automatically. It does not matter if they are up 1,000% on paper. If the margin call hits and they cannot cover it, their silver gets sold at whatever price the market will give them. And that selling triggers more margin calls on other traders, which triggers more forced selling, which triggers more margin calls. It is a cascade, a liquidation waterfall, and it has absolutely nothing to do with whether silver is worth $80 or $120 or $200. Deutsche Bank came out immediately after the crash and said, and I quote, "The adjustment in precious metal prices overshot the significance of its ostensible catalysts." They said investor intentions in precious metals, official, institutional, and individual, have not likely changed for the worse. Translation: the people who actually hold physical silver and gold did not sell. The people who got wrecked were paper traders using leverage. The weak hands got shaken out. The strong hands are still holding. Now here is where it gets really interesting, and this is the part I need you to hear, because this changes everything about how you should be thinking right now. Goldman Sachs just reaffirmed their gold price target of $5,400 per ounce by December 2026, and they said they see significant upside risk to that forecast. That means they think the price could go even higher than 5,400. Their model is built on 2 pillars. First, central banks continuing to accumulate gold at a historic pace. Second, private investors stepping up their gold ETF purchases as the Federal Reserve cuts interest rates. Both of those pillars are not only intact after the crash, they are actually strengthening. But Goldman is not even the most bullish bank on the street right now. JP Morgan just raised their gold price target to $6,300 per ounce by the end of 2026. That is up from their previous forecast of $5,055. That is a 30% increase from where gold is trading today, near $5,000. JP Morgan's model shows that central bank and investor demand should average around 585 tons per quarter in 26. That is a staggering amount of physical gold being pulled off the market every single quarter. And then you have Bank of America calling for $6,000 gold, Deutsche Bank reiterating their $6,000 target, UBS projecting $6,200, Wells Fargo raised their year-end target to $6,100 to $6,300 an ounce. Do you see what is happening here? Every single major bank on earth just raised their gold price targets immediately after the crash, not before, after. They watched silver and gold get hammered, and their response was to increase their targets. Now let me ask you something. If the bull market was actually over, would every major bank on the planet be raising their forecasts? Think about that for a second. Drop a comment below and tell me, do you trust the bank's price targets or do you think they are wrong? And while you are at it, hit that like button because the algorithm pushes this content to more silver and gold stackers when you engage, and I want every stacker to see this data. Now let us talk about silver specifically, because silver is where the real opportunity is sitting right now. As of today, silver is trading around $83 per ounce. That is up over 160% from where it was a year ago. Even after the crash, silver has more than doubled in 12 months. But here is the key data point that almost nobody is talking about. UBS is forecasting that silver will return to $100 per ounce by next month. Not next year, next month. They believe the speculative excess has been purged. The weak leveraged positions have been liquidated, and the market is now set up for a clean move higher on actual physical demand. And that physical demand is not going anywhere. More than 50% of all silver demand comes from industrial applications, solar panels, electronics, medical devices, electric vehicles, AI infrastructure. The electrification boom is consuming record amounts of silver, and that demand is structural. It is not going away because paper traders got margin called. In fact, while paper silver was crashing, physical silver premiums actually stayed elevated. The people buying real metal, actual bars and coins did not panic. They bought more. Now I want to connect something that most channels completely miss, and this is the real reason I made this video. There is a direct link between what is happening in tech stocks right now, what is happening with AI spending, and why silver and gold are about to move significantly higher. Google just announced they intend to spend $180 billion in AI-related capital expenditure in 2026. That is double what they spent in 2025. Amazon forecasts $200 billion in capex. These are mind-boggling numbers. And what do AI data centers need? They need massive amounts of silver for electrical contacts, conductors, and thermal management. Every single server, every circuit board, every connection point in these multi-billion-dollar data centers uses silver. The AI arms race is not bearish for silver, it is wildly bullish. At the same time, this explosion in tech spending is making investors nervous about the broader stock market. The S&P 500 and the Nasdaq are both down for the year. Software stocks are getting absolutely obliterated. Salesforce is down 28% in 2026. ServiceNow is down 33%. Anthropic released new AI legal automation tools, and the entire software sector dropped 7 to 8% in a single day. Where do you think nervous investors move their money when stocks start falling and the dollar is weakening? They move into gold and silver. History shows this pattern over and over again. And speaking of the dollar weakening, that is another massive tailwind that is still firmly in place. Morgan Stanley projects the dollar could fall another 11% over the next 12 months. A weaker dollar makes gold and silver more attractive to every buyer on the planet who is not using dollars. And right now, China's central bank has been buying gold for 15 consecutive months. 15 straight months of accumulation. They are not slowing down. They are accelerating. The World Gold Council reported that sovereign institutions added 230 tons of gold in the fourth quarter of 2025 alone. So let me lay out the full picture for you. Central banks are buying at a historic pace. The biggest investment banks on earth just raised their price targets to between $5,400 and $6,300 for gold. Silver industrial demand is surging because of AI infrastructure and electrification. The dollar is weakening. Stock markets are selling off. Inflation expectations remain elevated. The United States national debt just crossed $38 trillion. And yet, after all of this, silver just had a 30% pullback that cleared out all the leverage and speculative froth. If you are someone who has been waiting for a pullback to add to your silver and gold position, the market just gave you exactly what you asked for. Now, let me be clear. I am not a financial advisor. I am not telling you to buy anything. This is market analysis based on publicly available data from Goldman Sachs, JP Morgan, Bank of America, Deutsche Bank, UBS, and other major financial institutions. What you do with this information is entirely your decision. But I will tell you what I find fascinating. After every major precious metals correction in history, the pattern is the same. Weak hands get shaken out, strong hands accumulate, and then the next leg higher takes prices to levels that make the previous highs look like a floor. In 1980, silver crashed from $50 and then spent decades consolidating before eventually breaking out to new highs. But analysts like Peter Brandt are now saying 2026 is not 2011. The structural drivers this time are fundamentally different. Industrial demand did not exist at this scale in prior cycles. Central bank buying was nowhere near these levels, and the global debt crisis is orders of magnitude worse. The gold to silver ratio right now is sitting around 64-1. Historically, when silver is undervalued relative to gold, that ratio compresses violently during bull markets. If gold hits $6,000 and the ratio drops to even 50-1, that puts silver at $120 per ounce. If the ratio drops toward its historical average closer to 40-1 during a full bull cycle, you are looking at $150 silver, and some analysts are projecting silver could reach $200 before this cycle is over. Before I wrap up, I want you to really think about something. Every fiat currency in the history of civilization has eventually gone to zero. Every single one. The dollar has lost over 97% of its purchasing power since the Federal Reserve was created in 1913. Gold and silver have maintained their purchasing power for over 5,000 years. When you hold physical silver and gold, you hold something that is nobody's liability. It makes no promises, it pays no interest, and it does not depend on political decisions. It simply exists. And that is precisely why it provides security in a world where $38 trillion in debt and $180 billion AI spending sprees are considered normal. Smash that subscribe button right now. If you want daily silver and gold news and analysis, drop a comment telling me your gold to silver ratio prediction for the end of 2026 and hit the like button so more stackers can see this critical data. The banks have told you exactly where they think gold and silver are going. The only question is whether you are going to listen or whether you are going to let the mainstream media scare you out of your position right before the next move higher. I will see you in the next one. Stay stacking.